So what if one of the real foundational giants of the tech world, a name that basically meant innovation for decades, suddenly found itself, well, fighting for its very future? And what if that fight involved this absolutely monumental, multi-billion-dollar gamble, a gamble on technology, on geopolitics, and basically a complete reinvention of its business model? Welcome to the deep dive. Today, we're taking a really detailed look at Intel Corporation, INTC. We're analyzing its position, its prospects over this crucial 2025 to 2028 horizon. And look, this isn't just about a stock ticker, right? It's about understanding these seismic shifts happening across the entire semiconductor industry. Our mission for this deep dive is really to unpack all these complex forces at play. We're talking global demand shifts, geopolitical chess moves, I mean, even the very limits of physics. We want to help you quickly grasp the really crucial insights into Intel's, let's face it, ambitious turnaround strategy. Hopefully you'll walk away not just informed, but with a deeper appreciation for the high-stakes game being played here. We're drawing from an in-depth equity analysis, really meticulously dissecting market trends, Intel's strategic moves, its financial outlook, basically giving you a shortcut to being truly well-informed about this tech titan. Okay, let's jump right in. Maybe we should start by looking at the broader landscape, the whole semiconductor industry picture.
Yeah, absolutely, because it's a landscape that's transforming at, frankly, an incredible pace.
Yeah.
And understanding these macro shifts is completely essential before we even, dig into Intel specifically.
Yeah.
What we're seeing isn't just a typical rebound from a downturn. It's more like a fundamental re-architecture of how the semiconductor market even grows.
Okay, so a new growth paradigm,
Yeah.
something beyond just the old familiar drivers we used to talk about. What does that actually look like?
Exactly. The global semiconductor market is seeing this unprecedented expansion.
Yeah.
And it's driven by powerful new long-term trends, not just those cyclical rebounds we've historically seen. So the overall market, it's projected to grow from, let's see, about $681 billion in 2024 to well over $2 trillion by 2032.
2 trillion, wow.
Yeah, that's a compound annual growth rate, a CGR, of 15.4%. And what's fascinating here is that this isn't just recovery, right? It's a fundamental structural increase in the demand for computational power across the entire global economy.
Okay, $2 trillion. That's just an astonishing leap in only a few years. What are the key drivers? What's powering that kind of aggressive growth for the whole industry?
Yeah, we could basically point to what I like to call the big four drivers first, and arguably the most significant right now is artificial intelligence and machine learning, AI. It's creating just this voracious demand for high-performance computing HPC solutions. And we're talking not just GPUs, but also custom accelerators and critically high-bandwidth memory, HBM. You need that to feed data to these super powerful processors.
Right, HBM. You hear about that all the time now.
Exactly. And just to give you a sense of the scale, HBM demand alone grew 200% in 2024.
200%.
And it's expected to increase another 70% in 2025. This is truly where the future is being built, computationally speaking. Second, we've got data centers and cloud computing. I mean, the sheer volume of data being generated requires this massive, relentless build-out of infrastructure, right? For storage, processing, networking, and this fuels constant demand for server CPUs, memory chips like DRAM and NAND, high-speed interconnects. It's interesting, too, the computing segment, which includes these data centers, is actually forecast to overtake communications as the largest semiconductor end market from 2024 onwards.
Huh, okay. It's hard to really wrap your head around that kind of data growth, but yeah, you can see how it translates directly into just immense chip demand. What's next on your big four list?
Third is automotive electrification and autonomy. The automotive sector, believe it or not, is projected to be the fastest-growing semiconductor end market.
Really? Faster than data centers?
In terms of growth rate, yeah. A forecasted CAGR of 10% from 2024 to 2030. I mean, think about the transition to electric vehicles, EVs, and these new software-defined vehicles, SDVs. This is dramatically increasing the silicon content per vehicle. The semiconductor value in a car with, say, level 4 autonomous capabilities and an electric drivetrain could reach around $4,000.
$4,000 per car.
Per car. Compare that to the roughly $500 in a conventional level 1 vehicle today. That's a staggering 8-fold increase. Cars are basically becoming supercomputers on wheels. And then fourth, we have the Internet of Things, IoT, and edge computing. Just the proliferation of intelligent connected devices everywhere, our homes, cities, factories, it's driving demand for a huge array of chips. Everything from sensors and analog ICs to low-power processors that handle data processing right at the edge of the network, closer to where the data is actually generated.
Okay, so those are clearly powerful tailwinds for the whole industry. But you mentioned something earlier, a bifurcated market. What's the crucial implication of that, especially for a company like Intel, whose legacy is so tied to, well, PCs?
Ah, yes. This is a really critical insight when we think about Intel. While those AI-centric segments we just talked about are experiencing this explosive, almost hyper-growth, the traditional consumer markets like PCs and smartphones, they're maturing. After some significant declines in 2023, these markets are expected to see only modest growth, maybe around 4% in 2024. They're just not considered the primary engines of industry expansion for 2025 and beyond anymore.
Right, the big growth is elsewhere.
Exactly. So this structural divergence means that the overall market's high CAGR, that 15.4%, it's actually an average. It's an average of hypergrowth in these specialized high-performance areas mixed with, frankly, low single-digit growth in the legacy consumer segments. And this inherently benefits companies with focused leadership in the high-growth niches, right? Think NVIDIA and AI. But it presents a structural challenge to companies like Intel, whose revenue has historically been just overwhelmingly dependent on that maturing PC market. So Intel's future success, it's inextricably linked to its ability to execute a strategic pivot toward these new hypergrowth arenas. It has to.
That makes a lot of sense. Okay, so we've laid out the macro drivers, this fascinating market split. But the semiconductor world is also, famously cyclical, boom and bust. How is this new AI era reshaping those old patterns? Or is it creating entirely new ones?
That's an excellent question. Yeah. And the answer is yes. The industry's cyclical nature is absolutely being reshaped by the unique demands of AI infrastructure. It's creating a whole new set of opportunities and, frankly, risks. Historically, yeah, the industry's famously cyclical. Boom and bust patterns driven by demand, supply, inventory levels. High demand leads to shortages, right? Then everyone invests in new capacity, which often overshoots demand, leading to inventory buildups, falling prices, and then a downturn. Classic cycle.
Classic economics 101. So where are we in that cycle right now? Are we booming or busting?
Well, following a downturn in 2023, the market entered a pretty strong recovery phase in 2024, and we're seeing positive momentum expected well into 2025. Global semiconductor sales in the first quarter of 2025 actually increased a robust 18.8% compared to Q1 2024.
Okay, that's pretty strong.
Yeah, key indicators are positive. Inventories have been normalizing. Factory utilization rates are recovering. The World Semiconductor Trade Statistics, WSTS, they revised their full year 2025 forecast upward to $728 billion. That reflects that 15.4% annual growth we mentioned.
Okay, sounds like a strong recovery. But you mentioned before a structurally different upcycle, this AI-driven super cycle. What's the critical distinction here compared to past cycles?
Right, here's the critical distinction. Past cycles were often correlated with broad macroeconomic trends, overall consumer spending, things like that. The current cycle, in contrast, is just overwhelmingly driven by the massive capital-intensive infrastructure build-out, specifically for AI. And who's doing the spending? It's primarily a small cohort of hyperscale cloud providers, think Google, Amazon, Microsoft, Meta.
The giants.
Exactly. And this concentration has led some analysts to actually call it an AI-driven supercycle.
A supercycle driven by just a handful of companies. That sounds like it introduces a new dimension of, well, concentrated risk. Why should that matter to, the listener? Why should we care?
That concentrated risk is exactly the point you should care about. The sustainability of this whole expansion is now kind of tethered to the capital expenditure budgets and the return on investment calculations of a mere handful of corporate giants. It's not spread across a more diversified global economy anymore.
Right.
So what happens if these hyperscalers collectively decide to enter a digestion period? Maybe due to macroeconomic pressures, or maybe they just reassess their AI service revenues. If they tap the brakes, the impact on the semiconductor industry could be far more abrupt and severe than in a traditional cycle. This elevates the importance of watching those hyperscaler capital allocation plans. It's become a critical leading indicator for the health of the entire sector.
That makes sense. This concentration of demand in just a few big players also seems like it ties into another massive force reshaping the industry, geopolitics. We hear about this constantly, CHIPS Act, supply chains. How does it specifically impact semiconductors and, by extension, a company like Intel?
You're absolutely right to connect those dots. The intricate global semiconductor supply chain is being fundamentally reshaped by geopolitical tensions. It's leading to these big government-backed efforts to bring manufacturing closer to home or reshoring or friendshoring. I mean, the semiconductor supply chain, it's a marvel of globalization, really. Components traveling over 25,000 miles, crossing more than 70 international borders for just a single chip.
Incredible complexity.
It is. But this intricate network is heavily concentrated in East Asia, right? Particularly Taiwan and South Korea, which dominate advanced manufacturing. The COVID-19 pandemic and then escalating U.S.-China geopolitical tensions, they starkly exposed the fragility of this system. And that prompted this global strategic reassessment of supply chain security. Everyone got worried.
Yeah, it makes perfect sense that governments would react to that kind of vulnerability, especially for something so critical. What are they actually doing about it? What are these initiatives?
Well, in response, governments are implementing these robust industrial policies. The most consequential, certainly in the U.S., is the CHIPS and Science Act of 2022. This allocates roughly $280 billion in funding. That includes $52.7 billion in direct subsidies and a 25% advanced manufacturing investment tax credit, all to incentivize building chip factories, or fabs, in the U.S. The EU and Japan have similar multi-billion-dollar programs underway, too.
And is it working? Is it actually leading to new factories?
Oh, yeah. The CHIPS Act has already catalyzed a wave of investment. Over 100 new projects announced in the U.S., totaling nearly $540 billion in private investment commitments.
Wow.
As a result, the U.S. is projected to triple its domestic semiconductor manufacturing capacity by 2032 and potentially increase its share of advanced logic manufacturing, the really cutting-edge stuff. There may be 28% of global capacity. It's a big shift from where we are now.
Okay, now this is where it gets absolutely fascinating for Intel, because they're a major beneficiary of these subsidies, right? That funding must be critical for de-risking their enormous capital spending plans. But what are the strings attached? You mentioned golden handcuffs earlier that could limit their global reach.
Those golden handcuffs are indeed quite stringent, and it's a crucial point for Intel's strategy. Recipients of CHIPS Act funding are prohibited from any significant transaction involving the material expansion of semiconductor manufacturing capacity for advanced nodes in a foreign country of concern. And that most notably means China. For 10 years.
10 years, so they basically have to choose sides.
It's a critical trade-off, exactly. China remains a vital market. It accounts for a significant portion of global semiconductor demand and sales. For Intel specifically, China represented roughly 29% of its total sales in fiscal year 2024. That's huge.
Almost a third of their business.
Right. So by accepting CHIPS funds, Intel is irrevocably aligning itself with a U.S.-centric technology and manufacturing ecosystem. Now, this strategic choice, it definitely mitigates geopolitical supply chain risks and provides absolutely essential capital for their massive build-out. But it may also permanently limit the company's ability to fully participate in the Chinese market. This could accelerate the emergence of a sort of bifurcated global technology standard, potentially capping Intel's long-term total addressable market. The trade-off is crystal clear: near-term financial viability versus long-term unrestricted market access.
Okay, so as nations are redrawing the manufacturing map, the very nature of chip design itself is also undergoing this profound transformation. We're moving beyond the traditional limits that define the industry for decades. Can you explain what's happening there? You mentioned Moore's Law earlier.
Yeah.
Is that famous observation still holding true?
Well, the semiconductor industry is innovating along new vectors now to keep delivering performance gains. It's shifting from that traditional 2D scaling, just making transistors smaller, to a more holistic, system-level approach. For decades, progress was defined by Moore's Law, the observation that transistor density doubles roughly every 2 years. And for decades, it almost felt like magic, didn't it? Just keep shrinking. Everything gets faster, cheaper per transistor. But physics has a way of reminding us who's boss. As transistors approach atomic dimensions, the industry is confronting fundamental physical and economic limits. While miniaturization continues, the pace is definitely slowed. And critically, the cost per transistor is no longer declining at its historic rate. That signals a maturation.
Okay, so we're not just shrinking transistors anymore to get those big performance gains. What are these new innovation vectors, this system-level approach you mentioned?
Right, this marks a really pivotal shift. The industry is getting smarter about design and integration to continue delivering performance gains. We're seeing emerging architectures like chiplets and heterogeneous integration. The industry is rapidly moving away from large monolithic systems on a chip, SoC 6, towards a modular approach using these chiplets.
Chiplets, okay. Like Lego bricks for processors.
That's a great analogy, actually. It involves breaking a complex processor down into smaller, specialized dies, or chiplets. These can then be manufactured on different process technologies. Maybe one needs the absolute cutting edge, another is fine on an older, cheaper node, and then they're integrated together into a single package. What's really powerful here, this heterogeneous integration, is it allows for significant improvements in manufacturing yield.
Yeah.
Smaller dies are just less likely to have defects. It allows for cost optimization, use the expensive advanced nodes only where absolutely necessary. And you get better performance tuning for specific workloads. You build the best chip for the job using the best pieces.
That makes so much sense, especially from an efficiency and cost standpoint. But what enables all these tiny, specialized Lego bricks to talk to each other seamlessly at incredibly high speeds inside the package?
That's where advanced packaging comes in. And it's really the unsung hero of this whole chiplet revolution. Innovations like 2.5D packaging, where chiplets sit side by side on a silicon interposer, which is basically a super fast, tiny communication highway embedded right in the package, and 3D stacking, where chiplets are literally stacked vertically on top of each other. These allow for extremely high bandwidth, low latency connections between the different components. Technologies like Intel's own EIB embedded multi-die interconnect bridge and Foveros, or TSMC's CoWoS chip on wafer on substrate, these are at the forefront. And the advanced packaging market itself, it's projected to more than double from around $38 billion to $79 billion by 2030. That's a huge growth area, showing how critical it is.
So packaging isn't just the box anymore, it's part of the high-tech solution.
Absolutely. And of course, underlying all this, advanced process technology still matters deeply. The race to the bleeding edge continues. Leading foundries, TSMC, Samsung, and importantly, Intel, they're aggressively developing process nodes at the 2-nanometer scale and even beyond. This involves fundamental shifts in the transistor architecture itself, moving from the FinFET structures we've used for years to gate-all-around, or GAFET structures. Think of it like wrapping the on-off switch completely around the transistor channel. This gives engineers much better electrostatic control, which translates directly to more efficient and powerful chips. Furthermore, innovations like backside power delivery networks, BPDN, are set to be introduced. This essentially moves the power wiring to the underside, the basement of the wafer. This frees up valuable real estate on the top side for more logic, reduces electrical interference, and promises to improve performance.
Okay, so that's the complex, rapidly changing industry landscape laid out. Now let's finally zoom in directly on Intel itself. How is this tech giant navigating these monumental shifts? You said they're at a crossroads, undergoing a massive transition, right?
Absolutely. Intel is undergoing a really radical internal reorganization. The goal is to enhance transparency, accountability, and competitiveness. It all reflects their ambitious IDM 2.0 turnaround strategy. A key move, starting back in Q1 2024, was establishing this internal foundry model. This essentially created a customer-supplier relationship inside Intel between its manufacturing arm, Intel Foundry Services, or IFS, and its product design divisions, Intel Products.
So the chip designers have to sort of buy manufacturing services from their own factory division.
Exactly. This is a massive internal cultural and operational shift. It forces the internal manufacturing group to act like an external competitor, to win the internal business based on cost and technology, driving accountability.
That sounds like a huge internal shakeup. Were there other reorganizations more recently?
Yes. There was further streamlining in Q1 2025. The Network and Edge Group, NEX, was integrated into the client computing and data center and AI groups. So the structure now looks a bit simpler. It basically boils down to two main pillars now. Intel Products, which is their design and sales arm, and Intel Foundry, their manufacturing engine, plus, of course, their majority-owned subsidiary, Mobileye. Let's break down Intel Products first. This is the core business that designs and sells Intel-branded silicon.
Okay.
Within this, you have the Client Computing Group, CCG. Historically, this was Intel's largest segment, right? Focusing on processors like the Core series for the PC market notebooks, desktops. Performance here. In Q2 2025, CCG revenue was $7.9 billion, which was actually down 3% year over year, following an 8% decline in Q1. This really reflects that broader maturation and cyclical weakness of the PC market after the pandemic boom.
So what's the outlook there? Are they banking on these new AI PCs we keep hearing about?
Very much so. The near-term future for CCG is closely tied to the enterprise PC refresh cycle, and, crucially, the market's adoption of AI PCs. Intel is heavily promoting its new processors that have integrated neural processing units, or NPUs. They've set a target to ship over 100 million AI PC-capable CPUs by the end of 2025. Success in this new category is absolutely critical for revitalizing growth in this historically dominant but now maturing segment. It's their big hope for PCs.
Okay, and what about the data center side? That seems so critical, especially with the AI explosion we discussed earlier. How is that performing for Intel? What's the DCAI group?
Right, that falls under their data center and AI, or GCAI segment. This group is responsible for the Xeon family of server processors, their AI accelerators, like the Gaudi line, FPGAs, which are now under the Altera brand as a standalone business, and other related silicon for the data center market. Performance here. DCAI reported revenue of $3.9 billion in Q2 2025, which was a modest increase of 4% year over year. But this segment represents the most critical competitive battleground for Intel. This is where they've ceded significant market share and, importantly, profitability over recent years, mainly to AMD.
So what's the plan to fight back there?
Future growth is highly dependent on the market reception of their next-generation Xeon processors, particularly the high-density Sierra Forest chips using efficient E-cores and the performance-focused Granite Rapids chips using powerful P-cores. A significant portion of the outlook also rests on their ability to establish the Gaudi line of AI accelerators as a viable alternative to NVIDIA's dominant GPU platform. But let's put that in perspective. Gaudi is projected to generate maybe $1.2 billion in revenue in 2025. That's a tiny fraction of NVIDIA's multi-billion-dollar quarterly data center revenue.
Wow, okay. That really puts the challenge in perspective. Can they truly compete there? It seems like a huge uphill battle.
It raises a very important question, yes. Can they truly compete effectively against such an entrenched giant in the AI space? So that's the product side. Then we have Intel Foundry, IFS, the manufacturing engine. This is arguably the most ambitious, maybe the riskiest part of their whole strategy. But how is it performing today?
Yeah, is it making money yet?
Well, IFS provides wafer manufacturing, packaging, assembly, and test services both to external fabless customers and to Intel's own internal product groups. Remember that internal model. IFS reported revenue of $4.4 billion in Q2 2025, up 3% year over year. But despite that revenue, the segment is deeply unprofitable.
How unprofitable?
It posted an operating loss of $2.8 billion just in Q2 2024, and it's expected to continue generating significant losses until at least 2027.
Ouch. Why such big losses?
A direct result of the massive R&D and capital investments required to catch up on process technology. Plus, they're dealing with the underutilization of their older, less cost-competitive process nodes. They're building for the future, but it's costing them dearly right now. The success of IFS, though, is the cornerstone of the entire IDM 2.0 strategy. Its future is contingent on two absolutely critical factors. One, the flawless execution of that aggressive 5 nodes in 4 years technology roadmap. And two, their ability to win high-volume orders from major external customers for their forthcoming Intel 18A process. This is truly a make-or-break moment for the company's whole future direction.
Okay, and then there's Mobileye, the automotive connection. How does that fit in now that it's partially spun out?
Right, Mobileye. It's a majority-owned, publicly traded subsidiary. They're a market leader in IDS advanced driver assistance systems and autonomous driving technologies. After its IPO back in October 2022, Intel kept majority ownership. They hold all the Class B shares, giving them about 99.4% of the voting power. So they're still very much in control. It's treated as a strategic partnership where Intel provides technical and manufacturing support. Interestingly, though, Intel has shown a willingness to monetize its stake, likely to improve its own balance sheet.
Selling off parts of it.
Exactly. In July 2025, Intel sold about 57.5 million shares of Mobileye for roughly $922 million. This provided a handy source of capital while allowing them to still maintain control and strategic exposure to that high-growth automotive market.
Okay, this new structure definitely sets the stage. But to truly understand Intel's challenge, we need to compare it head-to-head with its rivals. You mentioned AMD, NVIDIA, TSMC. What does the competitive landscape look like now, quantitatively? Can you give us some numbers?
Yeah, the numbers really tell the story of how significantly Intel's competitive standing has eroded. They're facing best-in-class competitors across their core markets now. Let's do a quick quantitative snapshot because it paints a stark picture of this new reality. In the overall x86 CPU market desktops, laptops Intel holds about, let's say, 72.9% unit share as of 2024.
Still the majority, but...
But yeah, that's down significantly from their historical dominance of over 90%. Now look at server CPUs, the really high-margin stuff. Intel's revenue share is now around 55%, while AMD has surged to about 40% as of Q1 2025.
From over 95% share just a few years ago, that's dramatic.
It's a massive shift. Now, discrete GPUs, the adding graphics cards, crucial for high-performance gaming and AI. NVIDIA utterly dominates with 92% unit share. AMD has 8%. And Intel currently sits at essentially 0% as of Q1 2025 in this critical market.
0. Okay. And the foundry market, where they want to compete with TSMC.
Right. In the external foundry market, TSMC commands nearly 65% revenue share. Samsung has over 9%. And Intel, they don't even rank among the top 10 players yet.
Wow, those numbers really lay it bare. So breaking it down by technology leadership rather than just market share, where are the biggest challenges? Where do they need to make up the most ground?
The challenges are profound across the board. In CPUs against AMD, Intel has lost its clear performance leadership in both client, desktop, laptop, and server markets. AMD's Ryzen for client and EPYC for servers built using that advanced chiplet architecture and manufactured on TSMC's leading-edge nodes have consistently offered superior performance per watt and higher core counts. While Intel maintains overall unit share, the most severe damage, as we saw, has been in the lucrative server market, hitting their profitability hard.
And in AI accelerators against the NVIDIA juggernaut?
Yeah, in that critical market for AI acceleration, Intel is, frankly, a distant follower. NVIDIA's combination of high-performance GPUs and its proprietary CUDA software platform that's key has created this powerful competitive moat. It gives them a commanding market share estimated at over 80% in AI accelerators. Intel's Gaudi 3 accelerator. It has shown some competitive price performance in specific inference workloads, but its market traction is still nascent. And as we just highlighted, that revenue gap compared to NVIDIA is just enormous.
Okay, but maybe the biggest challenge, the root cause of many issues was manufacturing, right? Against TSMC and Samsung.
This is arguably Intel's most profound failure, the loss of its historical manufacturing leadership. For decades, that was their crown jewel. Those multi-year delays in their 10-nanometer and 7-nanometer process nodes were the absolute root cause of their product competitiveness issues. It allowed competitors using TSMC to simply leapfrog their capabilities. As of right now, mid-2025, TSMC and Samsung are in high-volume production of 3-nanometer chips. Intel, meanwhile, is still ramping its Intel 3 and Intel 4 processes, which are roughly equivalent to competitors' older 5-millimeter or 4-millimeter class nodes.
So they're still behind.
They are still behind. The entire success of the company's turnaround strategy now hinges on their ability to execute that 5 nodes in 4 years roadmap and deliver the Intel 18A process, that's their 1.8-nanometer class process, on schedule in 2025. They claim this will restore performance leadership. The future of this tech giant is literally being built 1 nanometer at a time. It's a truly defining moment, and the pressure is immense.
Immense pressure indeed. So Intel faces this formidable competitive landscape, but does it still possess any enduring advantages, any moats, as analysts like to call them, to help it navigate this turbulent sea? Or have those crumbled too?
That's a crucial question. And the answer is, well, mixed. Despite the recent challenges, Intel does retain some competitive advantages. But yes, its core strengths have been severely tested, and new vulnerabilities have definitely emerged. Let's start with the enduring advantages, the moats that still exist. First, their sheer scale and geographically diverse manufacturing footprint. Intel operates this massive global network of manufacturing, assembly, and test facilities. U.S. Oregon, Arizona, New Mexico, Ohio, also Ireland, Israel. This scale and geographic diversification, which is being further expanded with government support, is a significant asset. It's difficult and very costly for competitors to replicate. It provides supply resilience, and it's a key selling point for their nascent foundry business, especially in the current geopolitical climate we discussed.
Okay, scale and geography. What else?
Second, there's the x86 ecosystem. The x86 instruction set architecture, it remains the dominant standard for the vast majority of personal computers and data center servers. This creates this deep and wide ecosystem-compatible software, legions of developers with expertise, established enterprise IT infrastructure. All this generates significant customer switching costs and inertia. It's just hard to move away from something so deeply embedded in the digital world.
Right. The Intel Inside legacy is still powerful in that sense. Anything else?
And third, their brand and enterprise relationships. The Intel brand, okay, it's been tarnished, no doubt, but it still carries significant weight, particularly within the enterprise and OEM channels, the big PC makers. Decades-long relationships with major PC makers like Dell, HP, Lenovo, and with enterprise IT departments, built on a history of reliability and support, that provides a degree of stability to its business even now.
Okay, those are strong historical advantages, but you mentioned new vulnerabilities have emerged. What are those and how significant are they? Because those sound like the real worry points now.
Oh, the vulnerabilities are absolutely significant. First, and arguably the most damaging, is the erosion of technology leadership.
Hmm.
We keep coming back to this, but it's central. Intel's primary moat for decades was its undisputed leadership in process technology. The loss of this leadership is the company's single greatest vulnerability. It directly led to the erosion of its product performance advantage. The company has essentially transitioned from being the technology leader to being a challenger, desperately trying to catch up.
A complete role reversal.
That's exactly. Second vulnerability, a potential lack of strategic focus. Intel is fighting a multi-front war, isn't it? Against a series of highly specialized, best-in-class competitors. They're simultaneously trying to reclaim leadership in CPU design against AMD, build a credible AI accelerator business basically from scratch against NVIDIA, and launch a world-class foundry to compete with TSMC, all at the same time. This diffusion of resources and management attention, it stands in stark contrast to its rivals, who tend to excel by focusing intensely on one core competency. It really raises the question, can they truly do it all effectively? Or is this overambition spreading them too thin?
That's a really good point. And the third vulnerability.
Damaged execution credibility. I mean, years of repeatedly missing roadmap timelines, delaying product launches, it has severely damaged management's credibility of both customers and investors. And for a foundry business, which, let's be honest, sells trust and predictable execution just as much as it sells silicon wafers, this is a critical liability. It will take years of flawless execution to repair that damaged trust.
Okay, you've mentioned IDM 2.0 several times. This integrated device manufacturer model combining chip design and manufacturing, it used to be Intel's superpower, right? Then, as you said, it became a liability when manufacturing stumbled. Now it's the central element of their potential recovery. Can you unpack that transformation? Why is this IDM 2.0 such a radical bet?
It's a fascinating, almost paradoxical evolution. Historically, yes, that tight integration between design and manufacturing allowed co-optimization. It gave Intel a decisive advantage for decades. But when manufacturing faltered those 10mm and 7mm delays we talked about, it became a debilitating bottleneck. Intel's world-class chip design teams were effectively shackled to an uncompetitive internal manufacturing process. Their hands were tied.
So IDM 2.0 is the fix for that.
It's the radical attempt to fix it, yes. By decoupling the functions internally, it allows Intel's product designers to use external foundries, like TSMC, when necessary. This frees them from those internal bottlenecks. If TSMC has a better process for a certain chip, they can use it. Simultaneously, it forces Intel Foundry, the manufacturing arm, to operate with its own profit and loss statement, P&L, and compete for both internal and external business based on market terms. This drives accountability and efficiency. If successful, it could create a best-of-both-worlds model, leveraging internal scale but also having external flexibility. However, the execution risk is just immense. It requires a profound cultural shift inside Intel and the ability to operate two distinct world-class businesses under one corporate umbrella. That's a feat no semiconductor company has successfully managed at this scale before.
Okay, a truly radical transformation. And it's not just about structure. It's fundamentally about reversing what sounds like nearly a decade of decline and trying to seize these new growth opportunities. Let's look at Intel's recent past more closely and then what they're targeting for the future. What does a review of their historical performance tell us about the hole they're trying to climb out of?
Yeah, Intel's recent history, particularly the last 5-7 years, is marked by a period of really sharp decline and strategic turmoil. It makes this current turnaround plan such a high-stakes endeavor. Over the past decade, but especially accelerating from 2022 to 2024, Intel's financial performance and market position just deteriorated significantly. After years of enjoying those comfortable gross margins, consistently above 60% and dominant market share, the company entered this period of decline around 2018-2019.
How sharply did their key financials fall during this period? Can you give us a sense of the scale of that decline in revenue and margins?
Sure. Full year 2024 revenue was $53.1 billion. That was actually down 2% from 2023, which itself was a down year. But more alarmingly, their GAAP gross margin fell all the way to 32.7% in 2024.
From over 60% historically, wow.
Exactly, a stark decline.
Yeah.
The company posted a GAAP operating loss of over $11 billion in 2024. Their net profit margin as of mid-2025 was deeply negative, around negative 38.6%. This margin collapse reflects a few things. Lower factory utilization because they weren't selling enough chips, uncompetitive product costs from using those older process nodes for too long, and just intense pricing pressure from competitors like AMD.
Okay, and what about their investment levels? You hear about them spending huge amounts now, but
Oh,
what was the trend leading up to this crisis?
well, Intel has historically maintained high levels of R&D and capital expenditure CapEx. However, during the critical years leading up to its manufacturing crisis, its CapEx as a percentage of operating cash flow actually declined, while key rival TSMCs accelerated dramatically.
Ah, so they may be underinvested when they should have been pushing harder.
Arguably, yes. Now, under the new IDM 2.0 strategy, that trend has reversed completely and dramatically. Intel is now in the midst of this massive investment cycle. Plans for over $100 billion in CapEx through 2027. Gross CapEx for 2025 alone is targeted at $18 billion. That's a significant portion of their revenue, highlighting just how capital-intensive this turnaround attempt is. It's a huge bet.
So just to be crystal clear, what was the primary cause of this decline, this past strategic execution failure? What really led them to this difficult crossroads?
The primary cause, the root cause, really, of Intel's decline was its failure to execute its manufacturing roadmap. Simple as that, but with huge consequences. The company's 10-nanometer process, originally slated for way back in 2016, was delayed for years and, frankly, never achieved the performance or volume required for their high-end desktop or server products. This initial failure then had a cascading effect, delaying the subsequent 7-nanometer node, which they now call Intel 4, even further. This multi-year manufacturing gap allowed competitors, mainly AMD, using TSMC's reliable and advanced processes, to seize a decisive technological advantage. And that led directly to the market share losses we discussed earlier. It was fundamentally a self-inflicted wound that cascaded across their entire business.
Okay, it's a challenging past, no doubt. But Intel is now aggressively targeting the future, focusing on some of the industry's most promising growth opportunities we talked about earlier. Which of those are they prioritizing most heavily in this turnaround plan?
Yeah, despite the struggles, they are strategically positioning themselves to try and capture meaningful share in these large, fast-growing markets. The biggest potential growth vector, unsurprisingly, is AI and the data center. And Intel has a two-pronged strategy here. First, reclaiming server CPU leadership. With their next-gen Xeon processors, Sierra Forest and Granite Rapids, Intel aims to offer a more competitive product portfolio. The goal is to halt and potentially even reverse those market share losses to AMD. They're emphasizing a kind of workload-aware strategy, promoting their accelerated CPUs as a potentially cost-effective and easy-to-integrate solution for many enterprise AI inference tasks, the part where AI models make predictions tasks that might not require the absolute top-tier GPUs.
Okay, trying to carve out a specific niche there. And the second prong for AI data center.
The second prong is building that AI accelerator business. With their Gaudi line of accelerators, Intel is attempting to build a credible alternative to NVIDIA's GPUs. Now, the strategy here seems to be not competing head-on in high-end AI training, where NVIDIA is incredibly dominant. Instead, they're focusing on offering superior price performance for specific enterprise AI workloads, particularly in that inference market again. But it still begs the question we raised earlier. Can they really carve out a profitable niche against such a dominant player? Or is this a fight they simply can't win given NVIDIA's head start in ecosystem?
Right. And then there's Intel Foundry Services, IFS. Their incredibly ambitious bet to become a major external chip manufacturer like TSMC or Samsung. How is that opportunity shaping up? What are the tailwinds there?
IFS is definitely the most ambitious part of the strategy. The stated goal is to become the second largest external foundry by 2030. That's a huge leap from where they are now.
Second largest. Wow.
It's ambitious, but it's propelled by several powerful factors potentially. First, those geopolitical tailwinds we discussed. A growing number of companies and governments are seeking to diversify their supply chains away from that heavy reliance on Taiwan. IFS, with its significant and expanding U.S. and European footprint, is kind of uniquely positioned to capture this demand for a resilient, Western-based supply chain. Second, government support is key. The Cheech PS Act in the U.S., similar initiatives in Europe, they provide billions in subsidies. This directly lowers the cost of Intel's massive manufacturing expansion and makes it more competitive against the established Asian rivals. And finally, just by serving external customers, Intel dramatically expands its total addressable market. It goes beyond just selling its own products to potentially serving the entire fabled semiconductor industry companies like Qualcomm, Broadcom, maybe even NVIDIA or AMD someday. That's a huge potential shift in their business model.
Okay, that's a truly massive undertaking. Are there other areas they are targeting for growth beyond core computing and the foundry ambitions?
Yes, they're looking at automotive and edge computing for more diverse exposure, though maybe with slightly different approaches now. In automotive, while Intel actually recently announced the closure of its in-house automotive system on chip, so business, to refocus resources.
Oh, they shut that down.
Yeah, the internal design part. But they retain that majority stake in Mobileye. So this still gives them significant exposure to the high-growth ADS and autonomous driving markets, just in a more capital-efficient manner, letting Mobileye focus on it. For edge computing, as more data processing shifts from the centralized cloud out to the edge devices, Intel sees a significant opportunity. They're promoting an open ecosystem approach, providing AI-optimized processors like their Core Ultra series for PCs and edge devices, and software tools like OpenVINO. The idea is to enable partners to build and deploy AI applications in retail, manufacturing, smart cities, etc. And Gartner forecasts that by the end of 2025, maybe 50% of enterprise-managed data will be processed at the edge. That's a huge growth area for this kind of distributed intelligence.
Okay, so these opportunities are vast, no question. But realizing them depends entirely on the successful execution of Intel's overarching strategic playbook, IDM 2.0. Can you detail the core initiatives of the strategy again? What are the steps they absolutely must get right for any of this to work?
Right, the entire turnaround effort is orchestrated under this multifaceted IDM 2.0 strategy. It focuses on three main things: restoring manufacturing leadership, massive expansion, and a new operating model. The absolute central goal is restoring process technology leadership. This is encapsulated in that 5 nodes in 4 years, Plan 5N4Y. It's an incredibly accelerated roadmap designed to regain manufacturing leadership. This plan encompasses Intel 7, Intel 4, Intel 3, Intel 20A, and culminates with Intel 18A. That 18A node is scheduled to be manufacturing ready by the end of 2024 and in high volume production in the second half of 2025. The successful execution of this roadmap is simply non-negotiable for the company's long-term viability. It is the absolute core of the turnaround. If they stumble here, the whole strategy is arguably at risk.
That timeline still sounds incredibly aggressive, especially given their past manufacturing stumbles. What else does the IDM 2.0 playbook involve to support such an audacious goal? Are they just building factories?
Well, they are building a lot of factories. To support both their internal chip needs and their external foundry ambitions, Intel has embarked on this historic manufacturing expansion. We're talking over $32 billion planned for new and modernized fabs in Arizona, over $28 billion for 2 brand new fabs in Ohio, a $25 billion expansion in Israel, plus new advanced packaging facilities in Malaysia and Poland. It's immense.
Tens and tens of billions. How do they afford that?
These huge investments are partially de-risked, as we mentioned, by government incentives like the GPS Act, and also by what they call a smart capital strategy, which involves bringing in co-investment partners to show the massive financial burden. Building a world-class foundry, IFS, is the other cornerstone. And this involves more than just building the physical fabs. They also have to create the entire ecosystem around it. The process design kits, PDKs that customers use, IP alliances with other companies, the whole customer service infrastructure required to actually compete effectively with TSMC. That internal foundry model we discussed, implemented in 2024, is a key step here. It aims to instill the operational discipline and cost structure of a pure-play foundry across their entire manufacturing organization.
Okay, and you mentioned one more piece of the playbook, something about using other foundries.
Yes, and this is crucial. A key element of IDM 2.0 is the pragmatic, expanded use of external third-party foundries like TSMC. This allows Intel's product groups to use the best available process technology for any given product, whether that's internal or external. This provides a critical safety valve. It prevents their product roadmaps from being held hostage by delays in internal manufacturing, which is exactly what happened in the past. It's a pragmatic recognition that they need to be flexible and agile to succeed in today's fiercely competitive environment. They can't afford to be tied down again.
Okay, this ambitious playbook clearly requires an equally ambitious financial strategy. You mentioned the massive spending, the $100 billion plus. It must mean shifting priorities dramatically away from shareholder returns towards reinvestment. How exactly is Intel funding this future?
You're absolutely right. Intel's financial model has been completely reconfigured. They're prioritizing massive reinvestment in the business, funding it through a combination of increased debt, strategic asset sales, government help, and whatever operating cash they generate. Their balance sheet has expanded significantly to support these investment plans, with total assets nearing $200 billion as of the end of 2024. The increased capital spending has been funded through that mix: operating cash flow, though diminished, government incentives, co-investors, and a higher debt load. The company's total debt-to-equity ratio stood around 0.52 in mid-2025. That's manageable for a company their size, but it's definitely an elevated level for Intel historically. Strengthening the balance sheet is a stated priority, which is why we saw actions like that partial monetization of their Mobileye stake to free up capital.
It definitely sounds like they're burning through a lot of cash to make this happen. That must be impacting their free cash flow pretty significantly.
Oh, immensely. The company's financial model has become extremely capital intensive. Cash from operating activities, which used to be very strong, declined sharply from nearly $30 billion back in 2021 down to just $8.3 billion in 2024.
Wow, that's a huge drop.
It is. Meanwhile, their gross capital expenditures are projected to be $18 billion in 2025 alone. This significantly outstrips their operating cash generation right now. So this creates a substantial free cash flow deficit. That deficit is being bridged by those external funding sources we mentioned, government grants under the CSPAS Act, co-investment partners, and debt. Management is now very focused on improving capital efficiency. They've talked about slowing construction in Ohio, canceling some planned projects in Europe, basically trying to align spending more closely with market demand and preserve capital where they can. Also, like the rest of the industry, Intel is subject to inventory cycles. They're actively working to manage working capital, and that internal foundry model is designed in part to instill greater discipline in managing wafer starts and inventory. They have a stated goal of saving $10 billion in costs by the end of 2025 through efficiency measures.
Okay, given these massive investments and the significant cash burn, Intel's approach to shareholder returns must have changed dramatically too. What does this mean for things like dividends and share buybacks, which investors often look for?
You're right. Priorities have shifted drastically away from shareholder returns. Intel has fundamentally altered its policies, basically suspending dividends and buybacks to prioritize every available dollar for the turnaround strategy. For years, Intel was a reliable dividend-paying stock, right? A blue-chip staple for income investors. However, in early 2023, the company announced a drastic cut to its quarterly dividend. Then, in August 2024, management took the further step of suspending the dividend entirely. They stated the need to prioritize investments in the business and drive sustained profitability first. This move just underscores the immense capital requirements of the turnaround. It signals very clearly that returning capital to shareholders is just not a near-term priority. The focus is survival and rebuilding.
Okay, so no dividends for the foreseeable future. What about share buybacks? They used to buy back a lot of their own stock, didn't they?
They did. But share repurchases have also been completely halted since the second quarter of 2021, again, to preserve cash for these huge capital investments. As of June 2025, there was still about $7.2 billion authorized under their old buyback plan, but there's absolutely no indication that repurchases will resume anytime soon. And look, while Intel's historical returns on capital, like ROIC, were strong, they've collapsed in recent years. The ultimate success of this whole IDM 2.0 strategy will be judged by whether they can generate an acceptable ROIC on the more than $100 billion of capital being deployed. Given that the foundry business isn't even expected to be profitable until 2027 at the earliest, a meaningful recovery in ROIC is a very long-term prospect, and the risk of actual value destruction from these massive investments is significant if they don't pan out.
That really brings home the scale of the gamble. Will this huge bet truly pay off for long-term investors, or will it end up being a massive sinkhole for capital?
That is the $100 billion plus question exactly. Management's capital allocation priorities are now unequivocally focused on internal reinvestment. The hierarchy is clear. 1. Fund the R&D and CapEx needed to execute the 5N4Y process roadmap. 2. Build out the global manufacturing capacity for Intel Foundry. 3. Strengthen the balance sheet, returning capital to shareholders via dividends or buybacks. For the foreseeable future, that's just not a priority.
Okay. This whole financial restructuring, this massive strategic shift, it's all a direct response to a really challenging period for Intel. We've touched on it, but let's maybe look a bit closer at the specific challenges they faced between, say, 2022 and 2024 that really brought them to this critical juncture. What were the key company-specific issues?
Yeah, that period, 2022 to 2024, was arguably one of Intel's most challenging ever. It was characterized by severe execution failures and a significant loss of market leadership. The most critical failure, as we've discussed, was the multi-year delay in ramping both their 10-nanometer and 7-nanometer process nodes. These persistent manufacturing problems were the absolute root cause of Intel's loss of technological leadership. It allowed competitors like AMD, using TSMC's more advanced and reliable fabs, to deliver products with clearly superior performance and efficiency. The delays forced Intel to keep using its older 14-nanometer process for years beyond its planned lifespan, leading to a stagnant product roadmap, especially on the desktop side.
And the direct consequence of those manufacturing delays and uncompetitive products was a massive loss of market share, right, across their core segments.
Absolutely. In the high-margin server market, AMD's EPYC processors just steadily eroded Intel's Xeon dominance.
Mm.
We saw AMD's revenue share climb up towards 40%. That's huge. In the client space, too, PCs, AMD made significant gains, capturing nearly 29% of the desktop market by Q3 2024. And this competitive pressure wasn't limited to just AMD. Apple's successful transition to its own ARM-based M-series silicon for its entire Mac lineup represented a major loss of a high-profile customer for Intel. It also validated the performance potential of non-x86 architectures in PCs, which is a longer-term threat.
And the new foundry business, IFS, despite all the future promise, it hasn't been without its own challenges right from the start, has it?
No, that's correct. The launch of Intel Foundry Services has been fraught with difficulty. The business unit is incurring those substantial operating losses we mentioned, projected to continue until at least 2027. That's because it's investing so heavily in R&D and new capacity, while still operating older, less cost-competitive fabs. And winning the trust of major external customers has proven challenging, given Intel's recent history of execution failures on its own products. Why trust them with yours?
That makes sense. It's hard to rebuild that trust.
Exactly. And on top of all this operational and competitive turmoil, the period was marked by significant leadership transitions too. Bob Swan's tenure as CEO ended in early 2021. His successor, Pat Gelsinger, a returning Intel veteran, initiated the ambitious IDM 2.0 strategy. But he retired in late 2024 amid the ongoing financial losses and a declining stock price. The subsequent appointment of Lip-Bu Tan in March 2025 signaled another strategic reset, seemingly focused more on aggressive cost-cutting, operational efficiency, and a more disciplined approach to investment. This series of leadership changes and reorganizations, while perhaps necessary, has definitely created uncertainty and potential disruption to the company's long-term strategy execution.
Wow, so internal struggles, manufacturing woes, market share losses, leadership changes. It sounds like a perfect storm brewing inside the company. And these were compounded by a challenging external environment too, right? What were some of the broader industry-wide headwinds Intel faced during this period?
Yes. Intel's company-specific problems were definitely exacerbated by a confluence of challenging external factors affecting the broader semiconductor industry. It really was a perfect storm for them. First, the PC market decline. The end of that COVID-19 pandemic-era boom, where everyone bought new laptops and PCs, led to a sharp contraction in the PC market in 2023. This demand normalization, followed by a big inventory correction, created a significant headwind for Intel's largest business segment, CCG. Second, those geopolitical tensions we keep mentioning. Rising trade tensions between the U.S. and China created uncertainty for the entire industry. U.S. export controls on advanced semiconductor technology to China, while maybe aimed at competitors, also impact market access and create compliance complexities for global companies like Intel.
Right, navigating those restrictions must be tricky.
Very. Third, inventory corrections across the board. The industry experienced a significant inventory correction cycle in 2023, particularly in PCs, but also in smartphones. This depressed demand and put pressure on pricing as customers worked through all the excess stock they'd built up. Fourth, margin pressure from multiple angles. Intense competition, particularly from AMD and CPUs, led to significant margin pressure. At the same time, the sheer cost of developing and ramping these new leading-edge manufacturing nodes has increased the fixed cost base for all manufacturers across the board. It's just getting more expensive to stay at the cutting edge. And finally, regulatory and trade policy impacts. This global push toward industrial policy and semiconductor self-sufficiency like the CHIPS Act, while providing opportunities through subsidies, also introduces new regulatory hurdles and can distort global trade patterns. It creates a more complex and fragmented operating environment for everyone involved.
Okay, so we've laid out the complex industry landscape, Intel's deep challenges, both internal and external, and its ambitious strategic response, IDM 2.0. But what does this all mean for how the market actually values Intel today? And what are the ultimate risks involved in this colossal turnaround attempt? Let's talk valuation.
Right, valuation. And valuing Intel right now is exceptionally challenging, primarily due to its current unprofitability. This necessitates using a multifaceted approach, looking beyond just traditional earnings-based metrics. As of late 2025, many of Intel's standard earnings-based multiples, like the PE ratio, are simply not meaningful because they have negative GAAP and non-GAAP earnings per share, EPS. The trailing 12-month PE ratio, for instance, is negative. Other multiples, when you compare them to high-growth peers like NVIDIA or AMD, really reflect Intel's status as more of a deep value or turnaround play rather than a growth stock.
Okay, so what multiples can we look at? Price to sales, maybe.
Exactly. Price to sales, PS is 1. Intel's trailing 12-month PS ratio is hovering around 1.9x. Now compare that to fabless competitors like NVIDIA at maybe 28.7x or AMD at 9.0x. Even the foundry leader TSMC is around 8.7x.
So 1.9x is significantly lower. The market clearly isn't pricing in much growth based on sales.
Not at all. Now look at price to book, PB. Intel's PB ratio is approximately 1.1x. That means it's trading very close to its tangible book value, the value of its assets minus liabilities on paper. This suggests the market is valuing the company primarily on its existing assets, its factories, its IP, rather than its future earnings power. That can be a sign of deep value, or it can be a sign of a lack of confidence in future profitability.
A potential value trap situation. What about looking at earnings before interest, taxes, depreciation, and amortization EBITDA?
Yeah, EV/EBITDA is another one people look at to try and see past current net income issues. Intel's trailing 12-month EBITDA multiple is around 12.9x. Now, this is much lower than peers like NVIDIA at 50x or Broadcom at 48x, but it's actually higher than some other semiconductor companies. It reflects the market's attempt to sort of normalize earnings, but it's still depressed compared to the leaders. A direct peer comparison just hammers home this valuation gap. NVIDIA, Broadcom, even AMD trade at premium multiples reflecting their market leadership, high margins, or strong growth. Intel's compressed multiples clearly reflect its recent poor performance, its negative profitability currently, and the very high execution risks surrounding this turnaround.
Okay. Given how complex Intel's business is now with these distinct parts, the product design house, the foundry, Mobileye, a sum of the parts valuation seems like it would be particularly relevant here, right? Trying to value the pieces separately.
Absolutely. A sum of the parts, or SOTP analysis, is very relevant for Intel, precisely because it has these distinct business units with different growth profiles and different risk characteristics. So how would that work? You try to value each segment separately, Intel products, the CCG and DCAI groups. You can value this more mature business using a multiple of revenue or maybe a normalized operating income figure benchmarked against other established semiconductor product companies. Intel Foundry Services, IFS. That's much harder to value because it's currently so unprofitable. One approach could be to apply a forward-looking revenue multiple based on its ambitious 2030 targets, but then you'd have to heavily discount that future value back to the present day to account for the significant execution risk and all the negative cash flow expected between now and maybe 2027.
Right, that future value is very uncertain.
Highly uncertain. Then you have Mobileye. The value of Intel's majority stake there can be derived pretty directly from Mobileye's public market capitalization, since it trades separately. And then you'd add in other assets like the Altera FPGA business and maybe the value of Intel Capital's venture portfolio. Just as an example, one analyst's SOTP model from late 2024 suggested a fair value around $34.04 per share. At the time, that was significantly above where the stock was trading, indicating potential undervaluation if, and it's a big if, the strategic plan is executed successfully.
And you also mentioned asset value before with the low price-to-book ratio.
Right. Given that the stock trades near its book value, an asset-based valuation provides a potential floor, at least theoretically. The company's vast portfolio of manufacturing facilities, the fabs, plus real estate, and all its intellectual property, IP, that represents a substantial tangible asset base. It's an important consideration for a company with so much physical infrastructure. What are the factories actually worth?
Okay, understanding the current valuation is one thing, but making sense of Intel's future really requires some kind of framework for how its financials might evolve if this turnaround works. What does that path to recovery look like in terms of financial projections? What are the key milestones?
Yeah, projecting Intel's financials requires making some key assumptions about the success of this turnaround. And margin recovery and returning to positive free cash flow are the absolutely critical milestones everyone's watching. You have to build revenue growth projections segment by segment. For CCG, the PC group, you'd probably assume low single-digit growth, mostly driven by that AI PC cycle hopefully kicking in. For DCAI, the data center group, you'd model a gradual stabilization first, and then maybe a return to market-level growth. But that's entirely contingent on the competitiveness of those new Xeon and Gaudi products actually taking hold. IFS, the foundry. That's the most sensitive variable and the hardest to predict. Revenue growth there will likely be minimal until maybe 2026, 2027. Then you might see a steep ramp if Intel 18A is successful and if they manage to win major external customers. Lots of ifs.
Okay, revenue is one thing, but what about margins? Getting back to profitability is crucial, especially for the foundry. How do they get those gross margins back up from the low 30s?
The path to margin recovery is absolutely central to the whole investment thesis. The key drivers would have to be improved factory utilization as new, more desirable products ramp up and fill the fabs, transitioning a higher mix of their production to the more cost-effective EUV-based nodes like Intel 3 and beyond. Remember, EUV lithography allows for incredibly precise, smaller circuitry, which should improve costs and performance. They also need to achieve that stated $8–10 billion in cost savings they're targeting from the internal foundry model and other efficiency initiatives by the end of 2025. Management's long-term target is to return to non-GAAP gross margins of 60%.
60%. That would be incredible. Back to the glory days.
It would be a massive comeback, a level not seen in years. It truly would mark a financial renaissance if they could pull that off. Now, capital expenditures, CapEx, that will remain elevated in the near term. Gross target is $18 billion for 2025. Projections should probably model a gradual normalization of CapEx as a percentage of revenue after this current massive build-out phase is completed, maybe around 2026, 2027. And remember, net CapEx will be partially offset by those government subsidies. Finally, free cash flow. As we discussed, it's expected to remain negative for the next 2–3 years, probably. That's due to the combination of those depressed margins currently and the continued high CapEx. The inflection point, the moment they get back to positive free cash flow, that is a critical milestone for the investment thesis. It signals the business can finally start funding itself again.
Okay. Given this incredibly wide range of possibilities from a glorious comeback to continued struggles, it really feels like Intel's future is almost a binary outcome, success or failure. So maybe the most appropriate way to think about its valuation is through some kind of scenario analysis, bull case, bear case.
You've hit on the core challenge and the right approach, I think. Intel's future is highly binary right now. It makes scenario analysis the most appropriate valuation method. And the defining factor in those scenarios is almost entirely the successful execution of their technology roadmap. So the bull case, the optimist's view. Intel successfully executes the 5N4Y roadmap on time. Intel 18A achieves clear performance leadership over competitors. IFS secures at least one, maybe more, major external customers. Think Qualcomm, maybe NVIDIA, a big hyperscaler. DCAI stabilizes its market share, maybe even claws some back, and gross margins begin a clear trajectory back towards 50% or even higher. In this scenario, the stock could re-rate significantly higher as the market finally prices in a successful turnaround. That would offer substantial upside for investors who are willing to take the risk.
Okay, that's the dream scenario for Intel. What about a more pragmatic, middle ground base case, where things aren't perfect, maybe some bumps, but not a complete disaster either?
All right, the base case, the pragmatist's view. Let's say Intel's roadmap execution sees minor delays, maybe 6 to 12 months behind schedule, which historically wouldn't be unusual for the industry or even Intel. Intel 18A is competitive, but maybe it doesn't achieve clear, undisputed leadership. IFS manages to win some smaller customers, maybe for older nodes or packaging, but struggles to land that true whale customer for the leading edge. Margin recovery is slower, steadier, maybe reaching the 45–50% range over time. Market share losses in DCAI are halted, but not significantly reversed. This is a plausible path, but still challenging, and would likely imply more modest returns compared to the bull case.
And finally, the bear case, the skeptic's view. What happens if things really don't go as planned and this ambitious gamble falters badly?
Yeah, the bear case. Intel suffers another major delay or a significant technical setback with the critical Intel 18A process. Maybe yields are terrible, maybe performance just isn't there. The process ends up not being competitive with TSMC's equivalent N2 node. As a result, IFS fails to gain any meaningful external traction. The foundry business then remains a significant cash drain, potentially for years. Competitive pressures in the product businesses continue, leading to further market share erosion and ongoing margin compression. In this scenario, that massive capital investment, the $100 billion plus IQDR, fails to generate adequate returns. Intel turns into that classic value trap we mentioned.
A value trap. Explain that quickly.
It's where a stock looks cheap based on historical metrics or asset value, attracting investors hoping for a turnaround. But the business fundamentals are permanently impaired, so the turnaround never actually happens, and the stock price stays depressed or even falls further. Investors get trapped. Why this scenario analysis matters so much for you, the listener, is that the valuation is highly sensitive to the probability you assign to each of these outcomes. And the absolute key variable driving those probabilities is management's ability to execute on its technology and manufacturing roadmap. Period.
Okay, those scenarios really highlight the immense risks involved here. Let's dig into those risks in more detail as we wrap up. What are the key company-specific risks that Intel faces? The internal hurdles they absolutely must clear for even the base case to happen.
Right. An investment in Intel today is fundamentally a bet on them overcoming some substantial high-risk company-specific challenges.
Mm.
And it's primarily about execution. The single most critical risk is execution risk on that technology roadmap. The 5 nodes in 4 year strategy is exceptionally aggressive, maybe unprecedented. Any significant delay, yield issue, or performance miss on the critical Intel 18A process node would undermine the entire IDM 2.0 strategy. It would cripple the nascent foundry business before it even gets going and prevent the product groups from regaining competitiveness. Given Intel's poor execution track record over the past decade, this risk has to be considered very high.
Just the sheer technical challenge is enormous. And of course, even if they execute perfectly, the competitive threats they face are immense, coming from all angles, right?
Absolutely. They are fighting that multi-front war against highly focused and successful competitors. In CPUs, AMD has proven to be a relentless innovator and is unlikely to just roll over and cede its gains easily. They're fighting hard. In AI, NVIDIA's incumbency, its scale, and that powerful CUDA software moat present a formidable barrier to entry for Intel's Gaudi accelerators. It's not just about the hardware, it's the ecosystem. In the foundry space, TSMC's scale, its manufacturing expertise honed over decades, and its deep, entrenched customer relationships represent an enormous competitive advantage that will be incredibly difficult for IFS to overcome, even with government help. And then there's the broader, longer-term threat. The continued rise of ARM-based architectures in PCs, like Apple, and potentially more significantly in data centers. This represents a long-term structural threat to the x86 duopoly itself.
Okay, and this entire strategy sounds like just a huge financial gamble with that $100 billion plus in CapEx. What's the risk specifically around capital allocation effectiveness? That they just won't get a good return on all that money?
It is indeed a colossal gamble, financially speaking. The capital allocation effectiveness and the eventual return on investment are major risks. Intel is deploying over $100 billion in capital expenditures over the next few years. The risk that this massive investment will simply fail to generate a return that exceeds the company's cost of capital is significant. If the foundry business fails to achieve scale and profitability, this huge capital deployment could lead to substantial destruction of shareholder value. It could cripple the company financially for years.
A huge bet with potentially dire consequences if it fails.
Precisely. And finally, there's a risk around management credibility and strategic stability. The company has undergone multiple leadership changes and strategic shifts in recent years, as we discussed. The current strategy under CEO Lip-Bu emphasizes cost discipline and operational efficiency, which sounds good. But the long-term vision for IDM 2.0 was largely architected by his predecessor, Pat Gelsinger. Any perceived wavering from this long-term strategy, or, heaven forbid, further leadership turnover, could create significant uncertainty. And that could undermine the confidence of both customers and investors, which is the last thing a turnaround story needs.
Okay, so those are the significant internal hurdles. But beyond those, Intel also faces a complex web of broader industry and systematic risks, right?
Yeah.
External pressures that are largely outside of their control, but could still significantly impact their trajectory.
Absolutely. Intel's global operations mean it's highly exposed to a range of external systematic risks. These are inherent to the semiconductor industry itself and the current geopolitical climate. First, cyclical demand patterns. The semiconductor industry, despite the AI supercycle narrative, remains highly cyclical overall. A global macroeconomic downturn could still lead to a sharp contraction in demand for PCs, maybe even servers slow down, other end markets. This would severely impact Intel's revenue and profitability during this critical phase of its investment cycle, right when they need every dollar they can generate.
And we've talked quite a bit about geopolitics already, but just to reiterate, how does that play into the risks, specifically in terms of trade wars or even potential conflict?
Yeah, geopolitical and trade policy uncertainties are paramount risks for Intel. Their global operations are highly exposed. Further escalation of the U.S.-China tech rivalry could lead to new export controls or market access restrictions, impacting Intel's ability to sell into one of its largest historical markets. Remember, China was 29% of 2024 sales. Even more critically, while Intel's strategy is partly about providing a geographic alternative to Taiwan, an actual conflict in the Taiwan Strait region would cause unprecedented disruption to the entire global technology supply chain. The consequences would be severe and negative for all participants, including Intel. Nobody would be safe from the fallout of something like that.
A truly scary thought for the whole world, let alone one company. What about other external risks? Technology shifts, supply chains.
Yes, there's the risk of technology disruption and architectural shifts. The industry is in this period of rapid architectural innovation. While Intel is embracing chiplets and heterogeneous integration, a faster-than-expected shift away from the x86 architecture, maybe ARM, really takes off in data centers or PCs beyond Apple that could pose a long-term structural threat to its core business, diminishing the value of that decades-long x86 ecosystem advantage. And finally, supply chain and manufacturing concentration, even beyond Intel's own footprint. While Intel is diversifying its manufacturing, the broader semiconductor supply chain for critical manufacturing equipment, think ASML, for those essential EUV lithography machines, or for materials and substrates, that remains highly concentrated in just a few key suppliers. Any disruption to these key suppliers could impact Intel's ability to execute its own expansion plans, even if their fabs are ready.
Okay, we've covered a lot of ground today. This has been incredibly detailed. Let's try to synthesize this complex picture now into the core arguments for and against investing in Intel, essentially boiling down the bull case and the bear case as we head towards the end.
Yeah, let's try to crystallize it. The investment case for Intel right now is highly polarized. It's a classic battleground stock. The outcomes feel almost binary, and as we've said, they're almost entirely dependent on execution. So let's start with the bull case arguments, the path to a potential renaissance for Intel. Optimists believe Intel is right on the cusp of a technological and operational comeback, poised for significant upside if this ambitious strategy succeeds. The primary catalyst is the successful execution of IDM 2.0. That means, number one, the on-time delivery of a leadership-class Intel 18A process technology in 2025. This wouldn't just restore competitiveness to Intel's own product lines. It would also make Intel Foundry a credible, leading-edge alternative to TSMC and Samsung. That would be a huge leap, changing the global landscape.
So their manufacturing capability, getting that back on top, is absolutely key for any bullish outlook?
Absolutely central. Then you add the geopolitical tailwinds for the foundry business. As global companies and governments prioritize supply chain resilience, IFS is kind of uniquely positioned, right? It's the only potential leading-edge foundry with significant scale in both the U.S. and Europe. This could drive significant customer adoption, especially if supported by government incentives and maybe even mandates related to things like the GPS Act. This manufacturing success would then hopefully lead to product competitiveness and market share stabilization. With access to a leading-edge internal process, 18A, and the flexibility to use external foundries if needed, Intel's product groups could finally halt that market share bleed to AMD and servers and client PCs. A competitive product portfolio would allow the company to stabilize revenue and begin that long, slow process of margin recovery. And finally, there's the deep valuation argument that bulls point to. The stock is currently trading at a significant discount to its peers and very near its tangible book value. If the turnaround is successful, the market would likely re-rate the stock, stop seeing it as a broken value stock, and start valuing it based on a return to growth and improved profitability. That could offer substantial upside potential for investors willing to underwrite that significant execution risk today.
Okay, that's a compelling vision of a potential comeback story, a true American tech giant returning to form. But what about the bear case arguments? The peril of past failures, the skepticism that this massive, costly bet just won't pay off against formidable competitors.
Right, the bear case. Pessimists look at Intel's recent history of failed execution, the formidable strength of its competitors, and they view this turnaround as, frankly, unlikely to succeed. The core argument here revolves around continued execution failures. That 5 nodes in 4 years plan, it could just prove too ambitious. It could lead to further delays or performance shortfalls with the absolutely critical 18A node. A failure here would be catastrophic. It would invalidate the core premise of the entire turnaround strategy and essentially be a repeat of the mistakes of the last decade. Then there are the structural challenges in the foundry business. Even if 18A works moderately well, Intel may find it simply impossible to compete effectively with TSMC's sheer scale, its lower cost structure built over years, and its deeply entrenched ecosystem of partners and customers. IFS could fail to attract those necessary high-volume customers, becoming a massive unprofitable capital sink that perpetually drains cash away from the product businesses.
So those manufacturing issues, whether delays or just lack of competitiveness, could continue to hurt their own product businesses and potentially accelerate market share losses, even if they try to use external foundries sometimes.
Exactly. That leads to the risk of persistent market share erosion. Even if manufacturing improves somewhat, AMD and those ARM-based competitors may have built up enough momentum, customer loyalty, and performance advantage to continue taking share. Intel could find itself in a permanent position of just technological parity or maybe even lingering inferiority, leading to sustained margin pressure and an inability to truly regain its former market position. In this scenario, the combination of those massive capital expenditures and a failure to generate adequate returns leads to significant shareholder value destruction. The stock's low valuation, in this view, isn't a sign of opportunity. It's a reflection of a permanently impaired business model, that classic value trap we discussed, where investors keep buying in on turnaround hopes that simply never materialize.
Wow, clearly there's just so much on the line here. The resolution of this intense bull versus bear debate seems to hinge entirely on the answers to several critical questions and milestones over the next, say, 12 to 24 months. As we wrap up, what should we, as listeners tracking this high-stakes story, be monitoring most closely? What are the key signposts?
Okay, yeah, what to watch for. First, and most important, unequivocally, can Intel execute its 5N4Y roadmap on schedule? The single most important milestone is the start of high-volume manufacturing on Intel 18A, currently slated for the second half of 2025. Any announced delays, any pushback on that timeline would be a major red flag and would immediately impact confidence. Second, can Intel Foundry win a major, high-volume, leading-edge external customer? We know Microsoft has been announced as an 18A customer, which is great, but they have a long-standing relationship with Intel. Securing a large, traditionally fabless customer like a Qualcomm, maybe a Broadcom, maybe a hyperscaler, for a big custom chip design that would be powerful validation of IFS's technology and its business model. It would signal real market acceptance beyond just their anchor partners.
Okay, roadmap execution and a big external foundry win. What about from a financial perspective? Given the massive capital being deployed, what milestones should we watch for to gauge financial health and actual progress?
Financially, we need to see a clear timeline for Intel Foundry to reach operating break-even. Management themselves has guided for losses until at least 2027. Seeing a credible path to profitability, demonstrated through steadily improving operating margins in that foundry segment over the coming quarters and years, is essential to justify the ongoing massive capital investment. Also, critically, can the data center and AI group finally stabilize its market share? Monitoring server CPU market share data from third parties is crucial here. A halt to the steady decline in share would be the very first sign that the new Xeon products are truly competitive again. And finally, can the company actually achieve its stated cost-saving and margin recovery targets, seeing real progress toward that $8-10 billion cost-saving goal and witnessing a steady, tangible improvement in consolidated gross margins quarter after quarter? Those will be key indicators of whether this new operating model, this IDM 2.0, is actually working and turning the financial tide. Ultimately, as we've said, an investment in Intel today is a high-risk, high-reward proposition. It's fundamentally a wager. A wager that years of institutional inertia and technical missteps can genuinely be overcome through this combination of massive investment, strategic realignment, and renewed operational discipline. The path forward is absolutely fraught with challenges, and the outcome is truly far from certain.
Absolutely. We've navigated the intricate world of semiconductor dynamics. We've unpacked Intel's incredibly ambitious IDM 2.0 strategy, and we've weighed the monumental risks and opportunities. What really stands out, I think, is that Intel is making one of the biggest, most complex corporate bets in recent history, not just for itself, but arguably for the broader U.S. and maybe even European tech ecosystem. The key takeaway seems crystal clear. The future of this tech giant hinges almost entirely on one thing: flawless execution. Flawless execution of its 5 nodes in 4 years manufacturing roadmap, particularly that critical Intel 18A node, and its ability to establish Intel Foundry Services as a credible, competitive global player. So here's a final provocative thought for you, our listeners, to consider as you watch this unfold. If Intel succeeds, it won't just be a stunning comeback story for a single company. It could represent a potential reshaping of the entire global semiconductor supply chain, creating a more geographically diversified and perhaps resilient ecosystem, especially with strong hubs outside of Asia. But if it falters. If this massive effort, backed by billions in public and private funds, ultimately fails to deliver, what would that mean for the broader vision of a diversified, Western-centric chip manufacturing future? What implications might that failure have for concepts like technological sovereignty and global economic power balances for decades to come? It's a question I think that extends far beyond just Intel's stock price, something to really ponder.